How to pay yourself 34% interest, the infinite banking concept. Introduction, understanding the concept of banking and wealth extraction. In today's financial landscape, many individuals unknowingly pay a significant portion of their income towards interest, making banks the primary beneficiaries of their hard-earned money. The average consumer spends over 34% of their after-tax dollars on interest over their lifetime, a figure that significantly reduces the wealth accumulation potential. The conventional financial advice often centers around price and interest rate, but these are not the key factors responsible for draining wealth. Instead, the underlying issue is the banking equation, the systemic flow of wealth from the public to financial institutions. By understanding how to shift this equation, individuals can retain more of their wealth, with the potential to pay themselves the interest currently paid to banks and financial institutions. Footnote: this section introduces the concept of the banking equation, explaining the disproportionate amount of wealth extracted from the public through interest payments. The banking equation, a hidden financial trap. The banking equation focuses on the volume of interest rather than the interest rate itself. For instance, car loans at 8.5% APR and mortgages at 7% fixed APR seem reasonable on the surface, but the reality is that a large portion of the payments goes toward financing, not the principal. The true cost to consumers is the volume of interest paid, which over time compounds to substantial amounts. The fundamental mistake is that many consumers focus on the price and interest rate without understanding the long-term impact of these financial decisions. The solution lies in recapturing the interest paid to banks and financing companies by becoming your own banker. Footnote: this section highlights the misconception that interest rates and prices alone drive financial outcomes, emphasizing the importance of understanding the volume of interest paid over time. The concept of financing everything you buy. The first principle of recapturing wealth is recognizing that you finance everything you buy. Whether you're paying interest on car loans, mortgages, or credit cards, or giving up the opportunity to earn interest, you are always financing your purchases. The average American spends 34.5% of their after-tax income on interest but saves less than 5%. Yet, most financial discussions focus on getting higher returns on the small savings, ignoring the much larger amount spent on interest. This imbalance is like trying to fly an airplane against a strong headwind. No matter how hard you try, you're moving backwards. The solution is to redirect those interest payments back to yourself, effectively becoming your own banker. Footnote: this section stresses the importance of understanding that all purchases are financed, either through direct interest payments or opportunity cost, and the need to recapture this interest. How to pay yourself the interest you are currently paying. By becoming your own banker, you can start paying yourself the interest that you would otherwise give to banks and financial institutions. Instead of sending $34,500 per year in interest to external institutions, you can send that money back into your own system. The key mechanism for achieving this is through a permanent, participating dividend-paying whole life insurance policy. This form of life insurance, known as permanent insurance, is fundamentally different from term insurance. Unlike term insurance, which is temporary and progressively more expensive as the insured ages, permanent life insurance ensures coverage for life, while also offering opportunities for cash value accumulation. Footnote: this section introduces the concept of becoming your own banker through permanent life insurance, where the policyholder pays themselves the interest that would normally go to banks. The benefits of permanent life insurance for wealth building. Permanent life insurance is designed to accumulate cash value over time. The key to becoming your own banker is using this cash value for your personal financial needs, including major purchases like cars. By making premium payments into a life insurance policy, you essentially fund your own bank, borrowing from it when necessary and repaying yourself with interest. Over time, this allows you to retain the wealth that would otherwise be lost to interest payments. The quicker you capitalize your bank, the more efficiently this system works, especially when it comes to purchasing items that are typically financed through external lenders, like cars. Footnote: this section emphasizes how permanent life insurance can be used as a personal bank, enabling individuals to retain and earn interest on their funds instead of paying interest to external lenders. Comparing financing methods, banks, leasing, and savings. When it comes to financing major purchases, such as cars, you have several options: traditional bank loans, leasing, paying cash, using a savings account, or employing the infinite banking concept. For example, a car loan at 8.5% interest over 44 years would cost you $137,200 in interest. Leasing is even more expensive, amounting to $175,000. Paying cash for the cars requires saving up over several years, but the real advantage lies in the infinite banking system. By capitalizing your own bank, you can avoid the interest costs of external financing and instead pay yourself, ultimately resulting in significant savings over the long term. Footnote: this section compares various methods of financing car purchases and highlights the benefits of using the infinite banking system to avoid interest costs. The infinite banking concept, a wealth building strategy. The infinite banking concept is a strategic approach to managing your finances by using a dividend-paying whole life insurance policy to become your own banker. By saving and accumulating money within this policy, you can use the funds to finance purchases, such as cars, and repay yourself with interest. Over time, the growth of your policy's cash value accelerates, especially when compared to traditional savings methods. By year 50, you could have significantly more wealth accumulated using the infinite banking strategy than with conventional bank savings accounts, which offer limited returns and are subject to taxes. Footnote: this section details how the infinite banking concept works as a wealth building strategy, focusing on the advantages of using life insurance policies to manage finances. The advantages of life insurance over traditional savings accounts. By using a life insurance policy as your personal bank, you gain several advantages over traditional savings accounts. The cash value within the policy grows without being taxed, and you can borrow against it without triggering a taxable event. Furthermore, the funds in your policy are protected from creditors in most states, providing an added layer of security. The key difference is that, by becoming your own banker, you stop supporting the employees and shareholders of external banks and instead use the money you would otherwise pay to them to fund your own financial future. Footnote: this section highlights the benefits of life insurance policies over traditional savings accounts, focusing on tax advantages, creditor protection, and wealth retention. Conclusion: the power of becoming your own banker. Becoming your own banker is one of the most powerful financial strategies you can employ. By using a permanent, participating dividend-paying life insurance policy, you can recapture the interest you would normally pay to external institutions and build wealth for yourself. Over time, this strategy allows you to finance your purchases, save money on interest, and protect your wealth from inflation and market volatility. The key to long-term financial success is not just earning returns, but recapturing the money you would otherwise lose to interest, and the infinite banking concept provides an elegant and effective solution. Footnote: this section concludes the discussion on becoming your own banker, emphasizing the long-term financial benefits of using life insurance policies to recapture interest and build wealth.